Hello, fellow Ghost Traders. This is a market update for the week of 8/7/2023. We've just passed the midpoint of the current earnings season, and it has been a mixed bag of tricks. It appears that companies are being judged more on their forecasts than their current earnings. Apple beat earnings, but was pummeled by investors on softening outlook, gapping down more than 5% after their earnings announcement. Conversely, Caterpillar gapped up nicely on strong earnings and upgraded outlook, continuing to gain an additional 18 points post-gap. In macro news, Fitch Ratings downgraded its U.S. debt rating from AAA to AA+, citing a steady deterioration in standards of governance. The downgrade comes after lawmakers negotiated a last-minute debt ceiling deal of a $4 trillion increase and have since spent nearly half of that, demonstrating a very real likelihood of another debt ceiling standoff before the end of 2023. The Treasury response to this downgrade was cited as arbitrary, yet common sense would dictate otherwise. JP Morgan Chase CEO Jamie Dimon referred to the downgrade as ridiculous and irrelevant, but investors did not agree, as the news sent the market tumbling to 4 straight days of red. In banking news, Moody's cut ratings of 10 U.S. banks, including M&T, Pinnacle Financial, BOK Financial, and Webster's Financial. Additionally, Moody's put several major letters on notice for potential downgrade, including Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, Cullen/Frost Bankers, and Northern Trust. Finally, Moody's changes outlook to negative for an additional 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. These downgrades will further serve to destabilize the sector as depositors lose confidence in the fiduciary. In international news, China reports a double-digit plunge in July, exports and imports missing expectations by a very wide margin. Exports fell by 14.5%, while imports dropped 12.4%. The largest decline in exports were to the U.S., which was a 23.1% decline over last year. China's economic woes aren't just relegated to international trade. Domestic demand has also remained lackluster. Forecasts for the remainder of the year remain mixed. Optimists cite that the S&P will likely reach 5,000 before the end of the year. Bearish analysts disagree, citing technical data pointing to a textbook retracement in the markets. Fundamental analysis seems to favor the decline as well, namely higher than norm valuation multipliers. The benchmark index is currently valued at 21 times forward price to earnings, as opposed to a forward PE of 19 times multiplier over the past 7 years. In order to bring this variance into norm, the market could see a 10% correction between now and the end of the year. Now, Ghost Traders. As far as trading these troubled waters, the indexes are proving extremely volatile. The recalibration of the NASDAQ has led to short-term volatility. Add to that the banking woes, the downgrading of U.S. debt, and the mixed earnings keep your trades extremely short. Our biggest risk is time in the market. Great traders and great trades earnings can still be had. If your technicals are sound, hedge your long position premiums with short positions. Be willing to leave profits on the table in lieu of lower premiums and lower risk. In your short positions, look for earnings Wednesday forward with a Friday expiration. Take one step outside your normal trade position to give yourself a little more ribbon strike. Remember, earnings beats don't equate to stock gains. Look at Apple, UPS, and others. The market wants to see strong guidance moving forward. That's it for this, fellow Ghost Traders. Go out there, trade, and make today your masterpiece.